quick sound check. See if the audio is coming through okay, and then we can get started. It's the audio coming in a little bit low. Okay, let's do a quick check on the audio, if it's any better. Okay, let's go ahead. Audio seems to be good, and yeah, I think the audio is a little bit low. Let me just change this. Okay, let's try this. See if it's any louder. Sorry guys, just hooking up all my stuff, and okay, I think that's the best I can do. Let's go ahead so we're not wasting any more time. Welcome back everyone to another educational session. Today it's going to be Elliott Wave theory, and it is an introduction. We talked about Fibonacci last week. We are gonna put those Fibonacci's to good use in Elliott Wave theories. All right, it's okay. So my name is Vito and Henjoto. Thanks for joining in, and we can get started. Just a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. We do not offer signal service, manage funds, or other personalized advisory services. Please be aware of scams that promise guaranteed returns or manage accounts. I don't do that. I don't think OctaFX is offering that as well. CFDs and Forex are leveraged products that carry high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. All right. Yeah, you know what? I think I need to fix the audio. Just give me 1 second. Bear with me, yeah? You know what, guys? This is kind of the best I can do right now. If we are gonna tweak this, it's probably gonna be taking up a lot of our time. How's the audio right now? It's coming out a little bit low on my side too. Okay, audio should be back on, and I think we can get started, I guess. Back now? Yeah, it should be back now. Stream wasn't working on that. Okay, let's go. Turn up your volumes or whatever, and let's work with me here. Okay, there's a lot of talk about NFP tonight. We are not going to be looking at NFP directly, but if we do have time, I'm more than happy to discuss NFP and what's going on with the market. Okay. All right, so let's go on with Elliott Wave theory. So Ralph Nelson Elliott basically developed the Elliott Wave theory. Obviously, his name is Elliott. This was actually developed in the 1930s. So he basically believes that the stock market, and this is going to apply to the stock market and whatever market you're looking at, but we are going to be looking at stock market as the basis of it. So yeah, a lot of people thought, there's a lot of random stuff going on. There's a lot of chaos in the market. Chaos theory comes into play. But Elliott himself believes that market is actually trading in a repetitive pattern, a pattern that's continuously repeating. The idea behind it, if you take a look at the difference between Elliott Wave theory and the Dow theory, it's actually not that much of a difference. But basically, it is a theory that kind of agree on the thought that there are patterns in the market, and these patterns do repeat themselves. Otherwise, we wouldn't have technical analysis at this point in time. We would probably ignore any triangles, any flags, or whatever. We probably wouldn't be using fibs and stuff like that if there is no repetitive patterns in the market. So we are looking at this repetition in the market as kind of what's going on in the market. And that's basically the whole thing with technical analysis. We look at technical analysis because we know there are repetition in the market. We are basically looking at those repetition for reference points. So we look to the past for any potential future repetition, and that is basically it. And the only thing that distinguishes Elliott Wave compared to the Dow theory is actually the more accurate wave division that we can actually take a look at later on. But that's kind of the only thing that put this two apart, right? We actually have a little bit more accuracy in terms of wave counts, in terms of how far the market can go and stuff like that. So we are going to dissect the core of Elliott Wave theory and the basic patterns that are always repeated in the market. So we are looking at really basic stuff here. I saw a lot of people asking, what is this? I don't know what this is. This is going to give you a platform that you can get on, so you can kind of figure out what an Elliott Wave theory is. How do you look at that? But we're not going to delve deeper to those of you that knew your Elliott Waves. I don't think we have the capacity to talk about the more advanced patterns. So we are actually going to stick to the basics, get your basics really strong, and then in the future we could do a more advanced Elliott Wave sessions. But I will give you a glimpse of what's going on because there's a lot of confusion with the whole Elliott Wave theories here. Okay. All right. So this is the classic Elliott Wave. This is the 503 wave patterns. We have the blue ones that I highlight. Those are what we call the impulse wave. Right, anything that goes up, we call them an impulse wave. Now, this is again based on the stock market, so it's not really applicable if you reverse this and count the wave to the downside. So technically, this would only apply if you are looking at a potential uptrend in the market. So the whole 5-3 wave patterns doesn't work like the head and shoulder pattern where you can actually reverse it. You can say, hey, you know what, if the market's going down, we have the head and shoulder pattern. If the market has a potential to go up, then we can just flip it and call it the inverse head and shoulder pattern. We just cannot inverse an Elliott Wave. That's just the way it is. If someone tells you that, hey, you know what, you can actually flip the 1, 2, 3, 4, 5 to the downside, no, that's not gonna happen. All right, it just doesn't work as the basis of an Elliott Wave. We just cannot have that flip like that. Otherwise, we wouldn't have the ABC waves. We wouldn't have that ABC as a valid waves. All right, so this is only good if you are looking or tracking for a potential uptrend into the market. Doesn't work if the market is going down. If the market goes down, then it would either be in an ABC or could be in an ending diagonals, right? Or it could be a zigzag, or it could be in a flat, or it could be a double zigzags. It would fall into those categories. But if you are counting 503 wave patterns, you can only count this if the market goes up. All right, so logically, for every impulse move to the upside, we have the corrective wave. If you were here last week for the fibs, you would kind of understand what that is, because if we go by an impulse wave 1, if the market goes and create a 1 on the waves, that is actually an AB, and the corrective wave is actually a BC. So yeah, there are rules to this that you simply cannot break. So we have typically we have 1, 2, 3, up to 3 impulse waves. Typically we only have 1, 2, 3, 4, 5, and then an ABC starts to happen. This is a classic Elliott wave. So 1, 3, and 5 are what we call impulse waves. 2 and 4 are what we call corrective waves. Okay, just give me 1 second, guys. This is really nagging me. I just don't like it if I can't do my session properly. So give me a second. Just give me a second. Bear with me here. I'm going to unplug it. Okay. Yeah, it's just still not working. Okay. Audio should be coming through a little bit better, hopefully. Fingers crossed. I don't know. But let me know if audio is coming back okay. Okay, is it better? Okay, audio should be really good right now. That's really the best I can do. Okay. Alright, awesome. Let's get started. Okay, thanks. Alright, so let me quickly recap whatever's going on just now, because maybe I sound muffled or whatever. This is your classic Elliott wave patterns. We are looking at 3 to 5 wave patterns. Logically, it's only applicable to 1, 2, 3, and 1, 2, 3, 4, and 5. It's basically this whole cycle is only applicable in an uptrend or if the market is starting to trend to the upsides. Okay, if the market's really crashing to the downside, you cannot just reverse that 1, 2, 3, 4, 5 just like a head and shoulder pattern. It doesn't work that way. There's a proper wave count. There are rules attached to it. Okay, so wave 1, 3, and 5 are what we call impulse wave. Corrective waves are 2 and 4, and ABC are basically, I'll show it to you later on, but just keep in the note. It could be 1, 2, 3 ABC, or it could be 1, 2, 3, 4, 5 ABC. All right, so 4, 5 is a little bit of an extended. It's not a necessity. Wave 3 is a necessity if you're counting a wave. Okay, so wave 1 has to be an impulse wave. Wave 2 can be any correction pattern except a triangle. Okay, so it can be any correctional pattern except a triangle. It could be a flag. It could be It could be a head and shoulder even, that's still applicable. The only pattern that it cannot be, a wave 2 cannot be in a triangle. Okay, so if you're looking at a pennant, that would be a wave 1 followed by a triangle. So if you saw a pennant, that would kind of disqualify a wave 2. Wave 3 cannot be the shortest wave. It cannot be the shortest impulse wave. So wave 3, it's basically the bulk of the trend, right? That's wave 3 is basically where retail traders trade. Retail traders do not trade wave 1. Retail traders will trade wave 3 and wave 5. So yeah, wave 3 compared to 1 and 5, it has to be the longest. Wave 4 cannot overlap with wave 2. Okay, so you see where wave 4 ends? It cannot overlap with wave 2. I'll show it to you in the chart later on. Wave 5 has to retrace more than 70% of wave 4. Okay, so what it's saying is that wave 5 can actually be shorter than wave 3. It could end exactly at wave 3 or even shorter than wave 3. It would still count as wave 5 as long as wave 4 it's more than 70% of wave 5 is 70% more, 70% the length of wave 4. Yeah, does that make sense? And then we have the ABC, which is a completely different thing. Okay, so you can screenshot this if you want and then come back to this. It's completely fine. So let me give you the logic behind it. Okay, with Elliott Wave theory, repeated patterns are actually caused by trader psychology in terms of price movements, and I do pay a huge importance on price psychology. I look at psychological price levels. I think that there's a lot of things attributed to it. Okay, so this is more like a warning disclaimer to anyone that uses Elliott Wave. All right. Another thing is that this patterns, the 1, 2, 3, 4, 5 ABC, is actually constantly being formed throughout different time frames. So when you look at Elliott Wave and you also look at multiple time frames, there could be a little bit of a confusion there. It could either confuse you or it could really help you, and I will break it down later on. Okay, every wave that is formed will actually have a perfect cycle in it. We'll take a look at that in the next slide. So what I'm trying to say is that within a wave 1, there would be a completed 1, 2, 3, 4, 5 or 1, 2, 3 on a smaller time frame. Yeah, hopefully that makes sense. So if you're looking at a potential wave 1 on the daily, on the hourly time frame, it would have completed 1, 2, 3, 4, and 5, or maybe 1, 2, and 3 to actually form wave 1. Okay, so listen to this very carefully. I read this very carefully. The key to success in using Elliott Wave patterns depends on the identification and distribution of wave patterns by traders. Okay, so this will impact you using Elliott Wave by with it having a very high degree of subjectivity in the use of Elliott Waves. All right, it's not going to be easy for novice traders. So if you're thinking, oh yeah, you know what, I just started trading and I want to jump straight into Elliott Wave, don't do that. Go back to the past 5-6 weeks that we've done this every Friday and then come back to this one. But if you just jump in and you think this is interesting, do me a favor, go back to understanding the trends, go back to understanding fibs and stuff like that before you start using Elliott Waves. Because there's a high degree of subjectivity involved. What I'm trying to say here is that this is not objective in terms of identifying wave 1, 2, 3, 4, and 5. A lot of people will get it about the same. It won't be exactly the same. Okay. Typical waves are actually quite easy to identify. It's basically what I'm trying to say is that if a market goes up and there is a correction in the market, that's identifiable as wave 1 and wave 2, or an impulse and corrective wave. So get that in there. Okay, you are going to be looking at a lot of impulses. You're going to look at a lot of corrective waves. It's not looking at those impulse wave and looking at corrective waves to kind of get you, all right, you know what, I know this cycle, this is Elliott wave. No, it doesn't work that way. You'll see an impulse wave and then you'll see a corrective wave, and you need to identify what wave it is. Otherwise, you know, that's going to complicate a lot, matters a lot if you don't correctly identify what wave those are in. Okay, so to increase success in observing Elliott waves, pay attention and slowly count the cycles in the market. Do not ever rush Elliott waves. It's not, look, even on a 15-minute time frame, you're given a lot of time to actually properly count this wave, so don't rush into this. Okay, so if you counted the wave counts and it all makes sense, then you can actually anticipate future patterns easily. That's the whole thing. Just be super patient and you will be able to anticipate what's likely going to happen in the future. Okay, so this is what I'm trying to say. So if we have, look at the black lines, we have one impulse wave. All right, that's counted as wave 1. And then we have wave 2, which is a corrective wave. Within 1, we actually have 1, 2, 3, 4, 5. Okay, within that wave 2, we actually have an ABC. Okay, so this is how we actually try and identify Elliott waves. Do keep in mind that for every wave that you actually saw on the small time frame, there's actually going to be a completed cycle. And for an Elliott wave to be accurate, you will actually need to identify this completed cycles. If you saw an impulse wave and you cannot precisely identify on a small time frame a completed cycle, then it just won't work. Okay, so unfortunate to say, not every single time the market moves can be acknowledged or can be counted as a wave. Sometimes you cannot count those waves. If you want, you know, higher probability, you want higher accuracy, then you actually need to find a completed cycle within one wave. Okay, so for an impulse wave, it has to be a 1, 2, 3 or 1, 2, 3, 4, 5. For a corrective wave, it has to be an ABC. That's just about it. Okay. All right, so you can take a screenshot of this if you want to. In 6 minutes time, the NFE is going to come out. I'll update if there's any changes, if it's negative or positive, but we will focus on the the Elliott wave. So yeah, take a screenshot of this one. So for every impulse wave there is, you are actually needed to identify a 1, 2, 3 or 1, 2, 3, 4, 5. For every corrective wave, you will look for an ABC. A corrective wave cannot just be an A, it will actually have to be an ABC. Question, can we have the 5 wave in a bearish Forex market? As I said at the beginning, you cannot have this in a bearish market. You cannot just flip 1, 2, 3, 4, 5 and call it a day. So this will only apply 1 to 5 or 1 to 3 will always be an uptrend. The corrective pattern that you see, the ABC, will be a downtrend. And I'll just bring up the chart right now. The logic behind this is that this is, you know, driven by the stock market. So if I were to pull out the stock market and I were to give you that monthly view, you will see that the stock market actually continues to go up. It's technically never it never creates that 1, 2, 3, 4, 5 to the downside. Okay, so this is the logic of it. If you look at this, then you kind of understand what's going on here. I'll just delete a few stuff here. So, right. So take a look at the stock market. You know, going back all the way to the 1970s. I think that's how far data can push. But you just don't see an inverse Elliott wave in there, right? So this is why the inversion of an Elliott wave just doesn't work like a head and shoulder pattern or anything like that. This is a little bit more sophisticated than that. So to answer that question, you cannot have the 5 wave in a bearish market. It just doesn't happen. If you see a market in a bearish cycle, it's typically going to be in an ABC. There are more advanced patterns than this when it comes to Elliott Wave to actually identify what condition it is in a bearish market, but we won't cover that tonight. Okay, so screenshot this, take it in. And a lot of you are probably confused right now, but don't worry, we'll get along as soon as possible. Okay, so here are the rules to counting Elliott Wave. This is the rule to counting the classic Elliott Wave, which is the 1, 2, 3 or 1, 2, 5. We'll give you the rules here. Number 1, wave 1 must be an impulse wave, or a leading diagonal pattern, which is the more advanced type of patterns in Elliott Waves. So just think about it. Wave 1 has to go up. Okay, easy. Wave 2 cannot reach 100% retracement. What it's trying to say is that wave 2 cannot go back to the start of wave 1. Simple, yeah? Wave 2 cannot go back to the start of wave 1. So this is the problem with wave 1 and 2. It's really super hard to actually get the start of wave 1. It gets easier once you know where the wave 2 ends, and that's why a lot of people actually jumps in on wave 3. I'll break it down. Institutional traders are going to jump in at wave 1. They will start the cycle. Okay, they'll have that extra information. They'll know what to do. They can, if professional traders, fund managers, institutional traders, banks, they're going to be in a wave 1, right? Retail traders, I'll say it here right now, probably about 95% will not be in wave 1. Okay, because it's so hard to identify wave 1. There's a lot of risk involved in taking on wave 1. That's basically deciding, hey, you know what, market is going to turn up right now from a downtrend. That's wave 1. Okay, so that transition happened in wave 1. Typically, some experienced traders can actually get in on wave 2 and trade wave 2 and actually knows when to exit wave 2. If you were here last week, you can actually use Fibonacci retracement to identify where identify where wave 2 is actually going to end. Okay, but a lot of people will actually trade on the break above the start of wave 2. That's basically within wave 3. Okay, so wave 2 cannot reach 100% retracement of wave 1. It's usually between 50% to 78.6%, which we talked about last week during our Fibonacci session. Wave 2 can be any corrective pattern except a triangle pattern. So descending triangle doesn't work. Ascending triangle doesn't work. Symmetrical triangle doesn't work as a wave 2. Therefore, it will actually discredit a pennant. So if you saw a pennant, that is actually still a triangle. So wave 2 cannot be in those patterns, right? Typically, I like to see wave 2 within a flag or a descending channel. I like it a lot. If it is within a triangle, then we actually need to be a lot more careful. Okay. 263 was 250,000. Okay. NFP just came in. It is lower than last month, but higher than the expectation in the market. Unemployment rate remains stable at 3.7%. I'm sorry, I just have to update. Okay, wave 3 must be an impulsive wave. Okay, so wave 1, 3, and 5, it has to be an impulsive wave. Wave 3 must be bigger than the movement of wave 2. So there's actually a rule here. Wave 3 has to be longer or a much bigger movement than wave 2. Wave 3 cannot be the shortest impulse wave compared to wave 1 and 5. So therefore, wave 3 is going to be a much bigger trend than wave 1. Okay, it will be a much bigger impulse wave than wave 1. yeah, wave 3 is actually usually the biggest waves in terms of price movement. You'll actually see that wave 3 is actually the longest one, because that's basically the main trend. Wave 4 can be composed of any corrective pattern, so it can be a triangle this time around. It can be anything, right? Wave 4 can be anything. In terms of chart patterns, it can be anything that is a corrective pattern, obviously. Wave 2, so head and shoulder doesn't work because head and shoulder is going to be a reversal pattern, all right? So get that right. Wave 4 can be composed of any corrective patterns. This is really important. Wave 2 and wave 4 must never overlap. So if you draw wave 1, 2, 3, 4, the moment 4 touches 2, if it touches the price level of wave 2, it will actually you cannot count that as a wave 4. It will be the end of it. It will start being an ABC pattern. Okay, so simple as that. If you have a correction that you kind of guess this could be a wave 4 and it goes inside the range of wave 2, you have to cancel that wave 4 and that wave 4 becomes an A. Okay, so because of that one rule, it's okay not to have wave 5. That's why the patterns, can be 1, 2, 3, or it can be 1, 2, 3, 4, 5. As I said earlier, impulse wave, it's not going to be for retail traders. Corrective wave 2 can be traded by retail traders, but they either get it right or they either get it wrong. A lot of traders are actually are going to jump in on 3. A lot of institutional traders are actually going to get out at 4. The 5th wave is typically left alone to retail traders. That's why it doesn't have a huge price movement. Yeah. So I'm not trying to classify any traders. So I'm just giving you that information that retail traders or inexperienced traders are going to jump in at 3 and 5, while professional traders typically starts getting out at 4. We just typically don't trade the 5th wave. Okay. So 1, 2, and 3, you are going to see that happen. 4 and 5, you might not see that happen because of that one rule in where wave 2 and wave 4 cannot overlap, or they cannot meet, or the range cannot fall into the same area. All right, wave 5 must be an impulse wave, and it will be an ending diagonal. I actually have an example of an ending diagonal that we are going to take a look at. But wave 5 has to be that impulse wave, or it has to be in the form of an ending diagonal. Wave 5 must be at least more than 70% the price movement of wave 4. Okay, so it has to retrace more than 70% for it to actually be classified as wave 5. It might not go back to the end of wave 3, so it could actually be lower than wave 3 and would still classify as a wave 5. Can we see an example of a triangle? Yeah, definitely, man. Not a problem. You want to go into details on triangles, you can go back to the session about 3 weeks ago. We actually did talk about triangles in details, but I will show you a triangle if you want to. I'll pull it up right now. We still have a triangle on the dollar Japanese yen, right? There you go. We still have that. I wouldn't really want to call this a triangle anymore because we actually kind of broke the range, but yeah, that's that. What else is a triangle? Let me see if I can pick any triangles. Yeah, there's a lot of... Is there an ascending triangle here? Yeah, here's a triangle for you if you like your triangles. This is going to be an ascending triangle. Okay, can you pick it up? But we actually have a session based on triangles. That's what I'm trying to say is this. Try and follow through. If you jump in today and this is your first time ever, that's completely fine. go along with the information that I'm going to share. But if you really want to know the details or the basics of what a chart pattern is, what is a corrective chart patterns, what is not, we actually did run a session on this about 3 to 4 weeks ago. Okay, so these are the rules. Screenshot it if you want to. Okay, this is a completed wave 1 to 5 on the daily chart on the GBP USD. This is taken on exactly 2 years ago. We actually run this session 2 years ago. Can you believe it, guys? It's been 2 years. All right, so take a look at wave 1 and 2. All right, so wave 1 is going to be hard to pick up. Wave 2, you can kind of pick it up. Note the red line here is that wave 4, where wave 4 ends, it cannot end by, it basically cannot, it must never ever touch that red line, because that's the start of wave 2. Okay, so wave 4 cannot go into that area where wave 2 was. Okay, so take a look at the chart and follow through with me. We've got wave 1, basically from 20th of March 2020 to the 14th of April 2020, and that's wave 1. All right, wave 2, it's from April 14th to 18th of May. All right, so that's wave 2. That red line that we saw at 1.2650, this is it's a 2 years old chart. Obviously, we're still looking at an uptrend in a pound USD back then, 2 years ago. But what I'm trying to say, that one red line at 1.2650, which is also a psychological price level, a lot of traders are actually going to jump on board the uptrend on the break above 1.2650, and that's basically the start of wave 3. Okay. Don't worry about the small notes there, not wave 3, but it hits 127.2% extension. We're going to talk about that later on in terms of how to actually project the potential end of wave 3, because that's key. We need to know if we are in the third wave. We want to know when it ends. Okay, so we could get an approximation of when that ends by using Fibonacci. Obviously, there are several ways to do it. You can use expansions, you can use extensions. That's completely all up to you, but we are going to be using Fibonacci as an example. Okay, but to note, understand the rule. If you want to have a wave 5, wave 4 cannot overlap with wave 2, and this is one very important rule that a lot of people kind of ignore, and that's where they overstay in a trend by not being able to identify the end or the invalidity of wave 4. Okay, so if you really want to trade this properly and you really want to know if there's going to be a wave 5 or not, make sure wave 4 does not ever touch wave 2. Okay, so it just cannot overlap. All right, so here we go. Projecting end of wave 3, method 1. Okay, so we've got A, B as the first wave. Yeah, so if you take fibs from B to A, you are actually going to reverse the Fibonacci retracement. That's going to give you the end of wave 3, and this was the only exception in how you actually draw Fibonacci. So I'm not gonna stay here for too long, because a lot of people that missed out on last week's session is gonna get confused. But you can actually flip. If you take your Fibonacci from B to A, you are actually going to get the end of wave 3 at 161.8%. Okay, this could be that option. The other option is that you can actually take that Fibonacci extension from B to C. You will get the 127.2%, but it's not going to be the end of wave 3. But it will create, it will actually hit 127.2% and correct itself, but it's still going to be within wave 3. So if we do this, if we project the end of wave 3 by using this method where we actually do look for an extension from B to C, then you might actually not get the real end of wave 3. Okay, so this is basically what it is. If you take a look at where wave 3 ends, it doesn't really comply anymore with the Fib cycles that we have. So take your options. You know, you can project using several methods, but I prefer to use the length of wave 2 to actually project my extensions, because I don't need the end of wave 3. All I need is my 127.2 and my 161.8%. That's more than enough. If the market does extra, I don't quite care, and you guys know that in the month of August and September, I do get out of my position earlier than what the market actually pushed. And I'm actually pretty happy with it, because that's still within my whole trading plan. Okay. All right. So where do we begin wave counts? This is a triangle, by the way. So Kweku, you were asking about a triangle. This is why it's really important that we actually understand chart patterns first, and then we go on to the more advanced stuff. So yeah, I think, you know, I cannot stress it out enough. If you are a technical analyst, or if you're looking at using technical analysis to trade, you will need to understand the basic chart patterns, because if we broke out of a triangle like in this case here, we're not really going by the rules of wave 2 that cannot be in a triangle, right? Wave 1 typically starts at the break of that triangle. So this is the exception that we saw here. Wave 1 will typically start out of a chart patterns, and typically it will be a symmetrical triangle. Okay, so there are a lot of other tools that you can actually use. I have my Ichimoku cloud here just to give you an illustration that we actually have a transition to the upside. At the moment it breaks outside of that triangle. Okay, but wave 1 starts from there. That's why I said not a lot of people actually get to trade wave 1. A lot of people will actually trade the wave 3. If you take a look at what we have here on the Euro USD back in 2020, yeah, you can see where wave 4 ends, it doesn't even come near to the start of wave 2. So we actually have a valid wave. We actually have a third wave that's still longer than wave 5, so that's completely okay. We can even project where the end of wave 5 is by projecting Fibonacci's on the whole wave 4. So yeah, it gets really fun if you start to understand how to actually look at the market. We'll try to find some examples here, probably using dollar yen or maybe the dollar index, to see if we are actually still within any waves or anything like that. But from memory, one of the reasons I got out was the wave count ends for me. That was the reason why I got out on some of my position earlier in August and September, before it goes really crazy. Okay. Alright, so let's take a look at some of the advanced patterns here. We do have a flat pattern. That's your sideways market condition by looking at Elliott Wave counts, or your zigzag patterns. You got your double zigzag. If you really want to know what a zigzag pattern is, this is the zigzag pattern. Okay, typically zigzag patterns are period of consolidation, period of uncertainty in the market. So it is classified as something a little bit weird. It's not really, it doesn't really fit into an typical ABC. We just don't have the huge range of an ABC. Zigzag could show you that the market might look like it's going to start a downtrend, but it reverses back up again. So yeah, don't worry about this ones, okay? But I'm just showing it to you guys here because there's going to be a lot of questions that was asked, like the one that was asked earlier. If you can actually just inverse the wave to the downside, no, you cannot do that, but you actually do have several ways to count it. We got zigzags, we got double zigzags, we got a flat, right? You can still use projections, Fib projections in a zigzag pattern, for example. That's still completely fine. So the correlation between using Elliott Wave and Fibonacci's, I think it's there because we're looking at a corrective phase in the market. We can look at, a retracement that would actually fall within the corrective pattern, right? It will fall between 38.2, 50%, 61.8%. We will call that a normal retracement using Fibonacci. It will actually be in a corrective wave, okay? And then the impulse wave is going to be related to the extensions, which is anything beyond 100% that we also take a look at last week. Okay? All right. So just to give you an illustration, we got an hourly sterling yen here. Don't worry about this, just an illustration. But take a look at how the market is moving. We might actually have a potential start of a wave one, right? If we take a look at the hourly time frame here. So if we zoom in, you would actually be looking at a potential ending diagonals that would actually be classified as a wave 5. Okay, so this is a little bit more advanced. As I said, wave 5 can be within an ending diagonal. This is on a small time frame. So if we basically zoom in the hourly time frame, zoom into the 50-minute time frame, we can validate that first wave because we actually have an ending diagonal, which would equate to a wave 5. Okay, so I'm super okay if you understand the whole general if you understand the whole general terms of an Elliott wave theory, if you know what a wave 1, 2, 3, and 4 and 5 is, if you know what an ABC is. But I would say don't dig deeper if you don't get the basics and you don't like what Elliott Wave is, okay? Because you can trade without Elliott Wave. It's just that a lot of people are throwing Elliott Waves in there, thinking that that's gonna make them smart. It's not. It actually confuses a lot of traders, and I've seen this a lot in my 20 years of trading. Elliott Wave. A lot of people think, if I understand the wave, it makes me cool and stuff like that. No, it doesn't. The whole point in trading is that whatever is easy for you, I think that's the best way to look at things. So I would say to maybe about 90-95% of you guys out there watching this right now, whether live or pre-recorded, you kind of want to understand the basic or classic Elliott Wave theory, but to a lot of you out there, don't dig deeper because it's going to confuse you, and this is where I'm actually going to end the slide. Okay, there's no point really if you're trying to learn Elliott Wave, if you're trying to count the cycles in the market, and then you dig deeper without understanding the basic of it. I just don't think that's great. So yeah, I'll just give you a glimpse what you're actually going to come across. You're going to get a lot of the smaller wave counts that's really going to confuse you. So don't try to dig deeper than the classic Elliott Wave, at least not at this point in time. Okay, so I'm going to leave you with this. Opening up the the floor. If there's any questions, do ask. Okay, but yeah, it's good to know that you understand what an impulse wave is, you understand what a corrective wave is, you understand what a limit to a certain uptrend is. It's typically going to be limited to a fifth wave. We might have 5 extended, but again, that's going to be different. 5 extended is going to be an ending diagonal, so there's actually 1, 2, 3, 4, 5 at the end of it. That's basically what an ending diagonal is. So we don't count it as a wave 6. It will break the rules of a wave 5. It might look like wave 5 is as long as wave 3, but the end of it could be an extended wave 5, and it will actually be an ending diagonals. Yeah, Kristen, the videos that I do, if you go by the date, so it's super simple. Educational sessions actually every Friday. So if you want a previous video, you look for the 30th of September, 23rd, 16th, 9th, and the 2nd of September. I believe we started this around August. So we what are we in? I would think we are week 6 or something like that, or 7. Yeah. So sorry guys. Stick to the 1, 2, 3, 4, 5 ABC. Get going with it. Practice with it. Try not to get into the more advanced stuff. So yeah, if you know that the market's within wave 3, you can kind of predict where it's likely going to end and stuff like that. That's going to be useful. But if you really want to dive into Elliott Wave and use it as your primary methods of trading, that's completely okay. But I'm just gonna warn you right now, it comes with a lot of headaches, and it's not something that you actually pick up and go immediately. This is something that you actually delve in for years before picking it up on an easy basis. All right. So let's pull up something. Wow, that's nice. All right, maybe I'll help Albert on this one. Albert, if you are still on your Euro USD short, if you're thinking of moving your stop loss, you're waiting for the 13th of October CPI, I'll be honest with you, it's a little bit too far ahead. You jump it at 991, right? So you jump in right around there. Your initial stop loss would be up there. You can move it there if you want to. If you are still within this trade right now, there's a lot of momentum going on. I wouldn't want to aim for that 95.50 level, but if you take a look at 97 or 96.50, I think that's still plausible. You really want to lock in those profits. I think you can move it up to about 98.25 if that's my way of looking at things. This is a lot. You should be about 100 pips in. So I don't think you need to hold it until October 13th. I think it's a little bit too far. Okay, so maybe we'll use Euro USD as an example here. Are we looking at a wave 1, 2, 3, 4, 5, or where does the wave ends? Okay. I like using Ishimoku because I can see the transition that happens here. We can actually count this as a wave 1. So let me see if there's a tool for it. There is a tool for it. Elliott impulse wave 1, 2, 3. Okay, so we can actually measure this as 1, 2, 3, and this wouldn't be a 4. You know why? Because 4 got into the area of 2. So basically, if you want to know where 4 is going to be, it cannot fall between this range. Okay? So if we start wave counting and all of a sudden this happens, look at where I drew my 4 is. My 4 is actually within this blue zone. If you're wondering what that blue zone is, that's basically the area of wave 2. So you will know that there's not going to be a wave 4 because that push to the downside pretty much cancel it. Okay, so wave 3 looks good. How do we get the end of wave 3? A couple of ways. We can go by pulling a retracement, fib from 1 to 2 to get you your wave 3. Okay, I'm happy with 161.8%. Okay, it might go a little bit higher. It's okay. Or you can actually flip fibs around by doing this, which I wouldn't recommend if you are new to fibs, and get where the end of point 3 is going to be, which is there. Doesn't matter. I'm happy with whatever it is as long as I kind of get a cue on where to get out. Okay, so wave counts pretty much ends there. And what is all this stuff going on here with the market continuing to go up? Well, technically it wouldn't be within an Elliott Wave cycle. So our Elliott Wave cycle pretty much ends prematurely over there. So is that a lot? That's about 150 pips, but at least you kind of get the much bigger picture of it. So the question next was then, can I then draw wave 1, 2, 3, 4, 5 to the downside? Can I do this? Yeah, I mean the tools is gonna let you do that, but is it right for you to do this? I don't think so. Okay, so this just won't happen. Okay, so if you start drawing at a wave like this, then that's wrong. Okay, it just doesn't work that way. This is wrong, and I would really need to type it here. This is wrong. You cannot draw a wave in a bearish market. Okay, so anyone that skipped here will see that, hey, I put a note there. This is actually a wrong thing to do, so don't do that. Okay. All right, maybe we'll look at something else as an example. We could take a look at, seriously, no one's even requesting anything right now? Okay, that's fine. Okay, let's take a look at this. Do we have a wave count on the pound USD? We could actually have a wave count, but it looks like it's actually an ending diagonal, so it might not be the best example here for a wave count. Can you look at it from a higher time frame? I think you can. But if you take a look at this one here, there's something here that makes this the start of wave 1 instead of this one. So this is where it becomes really hard. It's super hard to identify wave 1, right? So how do we actually draw wave 1? Do we actually start from here and count that as a wave 1? Or do we start from here and count that as a wave 1? So which one is it? Remember the example? Typically we start counting wave if it breaks a certain patterns in the market, right? If we drew a trend line here, the breakout actually happens there. So this is where, this is not where, this is why wave 1 is hard to predict, hard to identify. Okay, this is why wave 1 is really hard to identify. But if we take a look at this whole thing right now, which one is wave 1? I would go for this one as wave 1. Okay, doesn't matter what it is, we still have a proper retracement. Okay, so this one here where you actually find a little bit of support here, that's basically 61.8%. Completely fine, right? If you want to call that a wave 1. If we count from the new wave 1 here that breaks out, it's still retraced to 38.2%, so that's completely fine. So wave 1 is super hard to identify. But yeah, there's a lot of tools out there, and I like using my Ichimoku Cloud because you can actually see where the transition happens. And to me, my wave count always starts out. It's not the perfect example, but I'm happy with what it is. We could look at that as a. This is actually an ending diagonal. That's why if you take a look at how far wave 5 is, it is actually going to be longer than wave 3. It doesn't work that way. Wave 5 actually ends here. This is an ending diagonal at the end of it. So yeah, it does get a little bit confusing, but hey, what's important is actually understanding where you are in the cycle. 4, 5, I don't think it's really necessary. I'm happy with a market that you can identify 1, 2, 3. That's already a lot of price movement there. Aussie USD is forming a flag pattern on what time frame? Let me know on what time frame. Okay, I think that is why in the ABC correction, wave A and C are 5 waves up and wave B is 3 waves down. That's actually a tough one. A and C are 5 ways up, and 5B. Fundamentally, it doesn't work that way, but hey, whatever works, man. If you want to flip it, that's completely fine. But ABC typically have their own calculation towards it. ABC is not really composed of 1, 2, 3, 4, 5 on itself. Okay, so we got Aussie USD on a 4-hourly time frame. Someone was asking if there's a flag pattern. We don't have a flag pattern on the 4-hourly time frame at all. Don't have it, man. Sorry. Yeah, I'm not looking at any flag patterns because we just don't have that flag patterns here. That is not on the 4-hourly time frame. Not even on the daily time frame as well, because the only flag patterns that could exist here, it's a descending, sorry, a bearish flag, and that would be something like this. If that's the flag pattern that you saw, that's on the daily, and that was actually broken yesterday. So yeah, not seeing it on the 4-hourly time frames. Maybe this, but we don't have a long enough pole on the 4-hourly time frame. So yeah, don't have it, don't see it. Okay, right, any further questions regarding Elliott Waves? I know this is going to disappoint a lot of you, but all I can say is that, hey, take a look at this. There are rules to follow. The stuff on the charts here, that's basically the flag at the 4-hour was broken. Yeah, it was broken. It was broken yesterday. So it's not today. It's not right now. Okay, so yeah. 3 to 5 wave patterns, that's what we call classic Elliott Wave patterns. This is good enough to get you started. And I know this session, there's a lot of people that's actually confused, because we had a lot of people at the beginning of it, and right now we're nearly half of that people there. So yeah, you might be disappointed. Counting Elliott Wave is not as easy as it is. So if someone tells you, hey, counting Elliott Wave is easy, then yeah, there was someone that says at the beginning of the session, you know, don't trust anyone. Why would anyone, you know, who's that? I'm gonna read it out. Who's actually watching a broker teaching you how to make money? I'm not here to. I'm here as a speaker. I'm here to help you guys. And if I were to say this is a session that's easy for everyone, I would say, hey, you know what, guys? Elliott Wave so easy. It's so easy to count. Go ahead and count it. Super easy. You can see Elliott Wave every day. That's probably the thing I'm going to say. But no, I'm going to tell you right now, it's not as easy as you think it is. It's good if you want to get involved in Elliott Wave, but for you to get into Elliott Wave, you will need your basic understanding of the trend. You would need your basic understanding of the market condition. You would need your understanding of the basic chart patterns, price patterns that you need to understand. You would definitely need last week's session on Fibonacci if you really want to get started on Elliott Waves. Okay, so yeah, it's not as easy as you think it is. What time frame is more accurate with the Elliott Wave patterns? As I said, Elliott Wave patterns, every pattern just, I'm sorry, let me jump into this slide for you here. Okay, so we've got this on the hourly time frame. So we got this on the hourly time frame. Within that hourly time frame, within that wave that we have on the hourly time frame, we can look at a 50-minute time frame. There's actually going to be a cycle in there. So if you're asking me what time frame is more accurate with the Elliott Wave pattern, that's where it becomes problematic. Because if you take a look at the daily time frame, you look at one impulse wave, there's a completed cycle on the hourly time frame. If you look at the hourly time frame as a one impulse wave, you go into the 5-minute time frame, you're actually going to find a small cycle in there. So to answer that, I think all time frames are correct. It's just that what kind of market condition that you're looking at. And this goes back to the second week when we talk about trends, because every time frame will show you a different trend. Therefore, looking or saying what a trend is in the market is going to be subjective depending on what time frame you look at. Okay, so which one is more accurate? What time frame is more accurate for an Elliott Wave? Any time frame is accurate. Just stick to whatever you're comfortable with. If you're trading on the hourly time frame, use the hourly time frame. Do your wave counts on the hourly time frame. If you're trading on the daily, do your wave counts on the daily. That's completely fine. It's not about whether it's easy. It's about whether it's worth the time. Yeah. What's my take? My take on this is this. I think every traders need to understand 1, 2, 3, 4, 5 ABC. I think this is something that every trader needs to understand. Do you delve deeper into Elliott Wave? Is it worth your time learning about the zigzags, the double zigzags, or whatever it is? No, I don't think it's worth it. It's worth it if you're an investor. It's worth it if you're trading in a market that goes in one direction. Like it's not really one direction. You can actually short the stock market. It's just it's a little bit more complicated, and this is why the basis of Elliott Waves or basis of anything technical analysis is actually based on the stock market, right? We are looking at a completely different market scenario. That is why you cannot flip the wave 1, 2, 3, 4, 5 to the downside. But hey, you know what? Forex traders finds creative ways to look at things, and they just flip it. I've seen it done. I just don't like the idea of it. So yeah, is it worth it? Understanding 1, 2, 3, 4, 5 ABC is super worth it. I think it's a necessity if you really want to get a hang on to your technical trading. Delving deeper into the more advanced Elliott Waves, no, it's not worth the time. That's my opinion, right? I can be wrong. Someone probably loves the Elliott Waves a lot more than I do, a lot more than I love it. I just don't see the need in it. We're dealing with a market that's kind of different than a typical stock market. If you are trading in stock market, yeah, delve deeper into it, completely fine. So if you have an investor mindset, you want to hold it for years and so forth, you need to know what cycle you're in. But if you're just here to scalp the market, no, I don't think you even need 1, 2, 3, 4, 5 ABC. Intraday traders, you probably don't need 1, 2, 3, 4, 5 ABC. Swing traders, yeah, you know, the longer the term of your trading style is, I think the more a necessity understanding what wave you're in is going to be. But if you're a short-term trader, you get in, you get out, you know, you take 10 pips, 20 pips out of the market, which I don't trade like that, and this is why I still need to understand my 1, 2, 3, 4, 5 ABC. But yeah, it's not easy to count Elliott Waves. It takes time. It takes a lot of time. So if you don't have that time, if you don't have that patience, don't even bother. How do I get rich by investing? Jeez, man, you still asking stuff like that here? What am I supposed to answer on this one? What's your definition of rich, man? Because that's rich. If you're thinking you want to get rich by investing $100 and turn it into $1 million in 2 weeks, that's not even investing. So yeah. Start somewhere. If you want to get into investing and trading, you can start with a demo account if you want to. Try to figure out what you're dealing with. Try to understand what the market is. Okay, but yeah, honest opinion, I don't think you need to delve deeper into Elliott Wave. If you understand the basics of it and get a hang of it, get used to it, that's completely fine. But you know, if you want to delve deeper into the more advanced Elliott Waves, it's not really worth the time. There's a lot of other tools that we can actually use. Okay, so hopefully this session helps you out and answers a lot of that questions for you. But yeah, take a look at this screenshot if you want it. Take a look at this screenshot if you want to save it as well. These are the rules to a classic 1, 2, 3, 4, 5 ABC. At least live a life. All I can say is this: if you want to start investing or trading, make sure it's a money that you don't actually need. Okay, if your life depends on that, then you're better off not investing that amount of money. That's all I can say. Honest opinion, man. Okay, so I think we can wrap this session up. I don't think there's any questions regarding Elliott Wave. Everyone have a great weekend. I'll see you next week on Monday for the Outlook and the Telegram on Monday, and then on Wednesday for the LTS and Q&A session, and then we have another educational session every Friday. Okay, have a great weekend, everyone. Stay safe. Good luck with your trades.